Good morning, everybody. My name is Fanen Musa Anandeku, and I'm a PhD student at University of Technology, Malaysia, in the Faculty of Management. Today, I want to present on the moderating effect of bank competition on the relationship between income diversification and shareholder wealth maximization of banks within the West African Monetary Zone. Banks are the cornerstone of any economy. A diverse, profitable, and stable banking system is critical to economic prosperity. Banks act as financial intermediaries by facilitating capital flows from surplus to deficit units. Over the last decade, banks' primary strategic focus has been maximizing the value of shareholders. Traditionally, banks derive their revenue from lending activities. However, with the deregulation of the financial sector, especially in the West African Monetary Zone in the 1980s and 90s, banks have turned to alternative income sources such as fees, commission income, and trading. With the growth in the level of the income diversification strategy in the West African Monetary Zone and the possible risks associated with this strategy, it is pertinent to investigate this phenomenon. The West African Monetary Zone is characterized by concentrated banking sectors in countries like Sierra Leone, the Gambia, and Guinea, while banks in countries like Ghana and Nigeria operate in highly competitive markets. This diversity creates natural variation in bank competition levels, making it a compelling setting to examine moderation effects. Also, there is mixed evidence on income diversification effect. While income diversification is often promoted as a risk reduction and value enhancing strategy, empirical evidence remains mixed. Some studies find a positive relationship with shareholder value. Others find neutral or negative outcomes. This inconsistency suggests that contextual factors like market competition may play a critical role in shaping the impact of income diversification. The regulation of the banking industry through the removal of entry restrictions and interest rate liberalization opened opportunities for cross-border banking, allowing banks from member countries such as Nigeria and Ghana to set up subsidiaries, branches, or acquisitions in neighboring states, thus creating the level of competition in host countries. This led to the erosion of traditional interest income, thereby forcing banks in member countries to adopt income diversification strategies. There has been growing debate on the merits and demerits of the income diversification strategy. Proponents of income diversification such as Wu et al. 2024 and Sisi et al. 2017 argue that it enhances profitability and cost efficiency while reducing risk. However, critics such as Guyen 2018 warn that diversification can dilute a bank's core competencies and increase earnings volatility. Few studies have investigated the effect of income diversification on the shareholder wealth maximization of banks in the West African monetary zone. However, to the best of my knowledge, there's none that has investigated the moderating role of bank competition. The West African monetary zone, comprising the Gambia, Ghana, Guinea, Nigeria, Liberia, and Sierra Leone, was established in the year 2000 to secure a monetary union among its member states. This initiative aimed to create a single currency, a regional central bank, a single financial services supervisor, and a common market for goods and services. The liberalization of cross-border banking operations, primarily driven by member states' willingness to permit the establishment of subsidiaries of banks with headquarters in other African countries, is one of the three key factors propelling the transformation of the banking industry in the West African monetary zone. Both the Ghanaian and Nigerian banking markets account for 93% of total assets in the West African monetary zone. This study addresses three key research questions, and they include, firstly, what is the relationship between income diversification and shareholder wealth maximization? Secondly, does bank competition moderate this relationship? And lastly, what are the policy implications for West African monetary zone banks? The theoretical framework of this research is comprised of two key theories: the social conduct and performance paradigm and the agency theory. The agency theory by Jetson and Merkley in 1976 explains conflict of interest between principals, who are the shareholders, and agents, who are the managers. Managers may not always act in the best interest of shareholders because they might pursue personal goals. Example, job security, empire building, and prestige, instead of maximizing shareholder wealth. If income diversification improves performance and reduces volatility, managers are effectively working in line with shareholder wealth maximization. However, managers may pursue riskier non-interest activities that jeopardize long-term shareholder wealth if incentives are misaligned. The second theory is the structural conduct and performance paradigm, which originates from industrial organization economics. And some of the key authors are Mason, 1939, and Bain, 1951. In banking, structure refers to market concentration or competition. Conduct refers to strategic choices like diversification. And performance refers to outcomes such as profitability, efficiency, and shareholder wealth maximization. Banks operate in markets that may be concentrated or competitive. Structure shapes incentives for diversification. In concentrated markets, banks may have stable interest income streams and less pressure to diversify. Whereas in competitive markets, margin compression pushes banks to diversify into fee-based services, trading, and other non-interest activities. Under the social conduct and performance paradigm, if diversification improves efficiency and stabilizes earnings, this leads to higher shareholder wealth. However, if diversification leads to excessive risk-taking or economies of scope, then lower shareholder wealth is expected. This research focuses on two hypotheses. Hypothesis 1, income diversification significantly affects shareholder wealth maximization. Hypothesis 2, bank competition moderates the diversification / shareholder wealth relationship. The sample of this study includes 20 listed banks, 12 of them are Nigerian banks and 8 are Ghanaian banks. The period under consideration is 2012 to 2020, which includes a total of 170 bank year observations. Data is obtained from annual reports and stock exchange filings. Nigeria and Ghana are chosen due to deep capital markets, and also both countries make up 93% of total banking assets in the West African Monetary Zone. For the independent variable, income diversification is proxied by the Herfindahl-Hirschman Index for revenue concentration. The dependent variable is comprised of Tobin's Q and market-to-book ratio, which represents shareholder value maximization. The moderating variable is bank competition, which is proxied by the Lerner's Index. The control variables include bank size, proxied by the natural log of total assets, leverage, proxied by the ratio of equity to total assets, and credit risk, proxied by the ratio of loan loss provision to total loans. This study adopts the dynamic system GMM for estimation because it is preferred in banking research since it corrects for endogeneity by using internal instruments to control for simultaneity and reverse causality, which is often very hard to address with static models. Also, the system GMM handles dynamic relationships because shareholder value maximization often depends on its own past values. So system GMM allows inclusion of lagged dependent variables as regressors without biasing the estimates. For validity, the system GMM uses the Hansen test and the AR2 test. The Hansen test evaluates the validity of instruments, specifically testing whether the instruments are uncorrelated with the error term. The AR2 test is a GMM dynamic panel model. It's a common test for second-order autocorrelation in residuals of a first differenced dynamic panel model estimated by GMM. For the key descriptive findings, Nigerian and Ghanaian banks report an average Tobin score of 1.05, implying that they are fairly valued by the market. In terms of income diversification, banks across both countries generate on average 51% of their income from non-interest sources, indicating a moderate level of diversification. However, Ghanaian banks demonstrate significantly higher income diversification of 65% compared to Nigerian banks of 44.8%. This suggests that Ghanaian banks rely more heavily on non-interest income sources such as fees, commissions, and trading. When examining market competition, the average learners index for all banks is 0.42, indicating moderate pricing power. Nigerian banks exhibit greater market power of 0.46 than Ghanaian banks 0.33, suggesting less competition in Nigeria. This could explain why Nigerian banks depend more on traditional interest-based income, suggesting they can maintain profitability through interest rate spreads without needing to diversify income sources. The findings indicate that competition significantly improves the negative effect of income diversification on shareholder wealth maximization. In other words, banks with greater market power operating in more competitive environments are better positioned to benefit from diversified income streams. This result lends strong support to hypothesis 2. The alternative measure of market-to-book ratio is used for robustness checks. The interaction term remains positive and significant, and it also confirms that competition enhances diversification's impact on shareholder wealth maximization. In conclusion, diversification negatively affects shareholder wealth maximization alone. Competition moderates and improves this relationship. And the key takeaway is that competition matters in the West African Monetary Zone banking system. This study aids policy implementation of central banks of member countries and the College of Supervisors of the West African Monetary Zone and banks within the zone. For the College of Supervisors and central banks, this study shows the need from a policy standpoint to create a banking environment that will promote healthy competition by engaging in stronger cross-border supervision. For bank management, there's a need to engage in balanced diversification so as to enhance shareholder value. Thank you for having me.